So these are zeros. On year 5, there could be stuff. 3 things are going to happen. Well, I'm done with the land. Now I'm going to return it back to the firm. Okay? Because I behaved as if I purchased it from the firm for $20 million. Now I'm going to sell it back to the firm at 25, which is the estimated value of the land at the time. So I'm going to put a negative, because when you sell it, you have negative spending. For building and equipment, I have salvage value. Okay. I'm going to take the salvage value. I'm going to actually, let's call this template, because I have 2 different types of assets subject to depreciation. I'm just going to duplicate this one. And let's call this salvage value building. And I'm going to duplicate this again. Salvage value equipment. Now let's take salvage value building. I'm going to move these closer to parameters. So that navigating is easier. Salvage value equipment. Cost of purchasing, 25. Okay. Tax life of the equipment. Is it makers? Yes. Salvage value, pre-tax. Salvage year, project life. Where are you? Tax rates is the tax rate of the firm. And I immediately have the after-tax salvage value. Okay. So which means right here, I'm going to have negative that. That's for the equipment only. And let's do the same thing for building. We bought the building cost 5. Tax life is, I mean, I know 20 is there, but I don't like hard coding things. This is why I color code stuff, because I immediately know what my inputs are. Okay. In this case, I actually sold things at a loss. Here I sold them at a profit. Where are you? And I'm gonna deduct. Oh, I'm sorry. This is the wrong place. Negative of salvage value of the building. Negative of salvage value of the equipment. I already had the land in there. So it's as if I sold $35 million worth of capital equipment on an after-tax basis in year 5. Remember, this land, there is no tax issue on that land because I got it from the firm. I returned it back to the firm. IRS didn't get involved. But both building and equipment, I paid money to put them in place. I depreciated them over the years, and I got salvage, so IRS got involved. Okay, net capital spending is done. Now let me move this into another sheet. Let's call this sales, old and new. I can do all of this in one sheet, but this is a little bit cleaner. Units, new. There is nothing on year zero, obviously. First year sales, $1 million. Let me move that parameters closer to here. Okay. But remember, we're increasing sales by, where are you? 10% every year. We're not gonna do anything about these. Okay. Dollar sales, new. So I'm gonna need first year an increase of 375 in new net working capital, but every year I'm gonna take that percentage and apply it to the difference in sales. So on year one, by the end of year one, I have to increase net working capital by another 375. And in year 5, this is the accumulated change. I don't know why that's 0. It shouldn't be. Oh, there's a reason. That thing was fixed. Okay. And I'm going to put a negative in front of that. Because over the 5 years, I have $5.49 million worth of net working capital. And old, let's do this. Let me make this a bit smaller. Dollar sales, old. Since I'm reducing my sales, that's going to also affect my working capital requirements. You know, if I'm selling less, I need to keep less on inventory and accounts receivable. And the same formula will apply here. Since change in the sales of the old product is the same, there is no additional net working capital in years. So I can also change in so I have net capital spending done and change in net working capital done. Okay. I could have done that in a different sheet, but I'm not going to. Now let's income delete. Sales new.